Let's go back to the slides, and I don't remember which page we were on, but I think we were on page 8. We're talking about being consistent. You remember the consistency rule? If your cash flows are after debt payments, they're to equity investors, the discount rate has to be the cost of equity. If your cash flows are to all claim holders, then the discount rate has to be the cost of capital. Okay. Now, if you take cash flows to the entire firm, pre-debt cash flows, you discount them back at the cost of capital, you get the value of the entire business. Most of the time, though, we're still interested in valuing equity because we can't buy the business. I have to buy Tesla shares, Tesla equity. So my question is a pure mechanical one, which is you come up with the value of the business by discounting cash flows to the firm at the cost of capital. You want to get to the value of equity. And I need to subtract out the debt outstanding, and I'll give you the choices I have, and you tell me which of these I would subtract out. So I've done all the dirty work. I've done the value of the business. All I want to know is what do I subtract out to get to value of equity? I can subtract out the value of just the long-term debt. You go to the balance sheet, you look at the long-term debt. Choice one. Second is I can subtract out the value of all debt, including all interest-bearing debt. Third is I can subtract out any debt that I included as debt in my cost of capital. Remember, this is not the first time I'm bringing debt in. Debt had to show up in my cost of capital. Or maybe I should be subtracting out the value of all liabilities on the firm, which should include accounts payable. Let's start by ruling things out I should not do. Which of those 4 would you rule out right away? You should never subtract out accounts payable, supply credit, because it's non-interest bearing debt. If you do that, then your whole valuation is going to blow up. So that's out of the picture. You shouldn't subtract out just long-term debt. I've never understood bankers who use just long-term debt and say, you know what, you don't owe the rest of the money. It's not, you don't have to pay it back. It's still debt. So the real choice is it becomes interest-bearing debt, and you should check for consistency. One of the reasons I say that is until 2019, accountants did not capitalize leases. They didn't treat it as debt, but I did. So when I looked at lease commitments, I converted them to debt. And because I converted them debt and brought that into my cost of capital as debt, when I got to this stage in the process, I had to subtract out debt, including lease commitments. So make sure that whatever you're calling debt in your cost of capital and what you're calling debt in this correction happen to match. So let's say you do it, right? You value the firm, you subtract out that, you get a value for equity. But you could have valued equity directly, right? By taking cash flows to equity and discounting at the cost of equity. Would you like to get the same value for equity with the 2 approaches? We'll ask the question, should you, but would you like to? I mean, let's say I'm your managing director. I ask you to value a company, and you do it with an equity valuation, come up to $25 per share. You come up firm valuation, subtract that, and come up with $35 per share. The stock is trading at 30. Think about that visit you're going to make to my office to tell me what you think this company is worth. It's going to be extraordinarily awkward, right? Because you say on an equity basis, the stock is expensive, but on a firm base, it's the same company again. It's like currency switching. Done right, you should get the same value for equity, whether you take cash flows to equity and discount at the cost of equity, or you take cash flows of firm, discount at the cost of capital, and subtract out debt. Easier said than done, but you should get the same value. So I'm going to set up a very, very simplistic example for the moment. You're going to say, where did the numbers come from? Just take the numbers as given, at least for this purpose, because I want to illustrate how you approach equity valuation as opposed to firm valuation. So here's the example. You have a company that has cash flows to equity. So I've done the calculations, the cash flows left over after debt payments. There are the interest expenses after taxes. And if I add the 2 up, I'm going to get the cash flow to the firm. So I've given you cash flows to equity and cash flows to the firm. I also give you a cost of equity. So the cost of equity is 13.625%. And the cost of borrowing money pre-tax is 10%. Tax rate is 50%. So your after-tax cost is going to be much lower. It's going to be 5%. So you have a choice. You can take cash flows to equity and discount them at the cost of equity. You can take cash flows of firm and discount them at the cost of capital. But to get a cost of capital, you need weight. So I give you the market value of equity as being 1.073 billion and the market value of debt at 800 million. So as I said, the numbers seem to come out of nowhere. Hang in there for the moment. Here's what I'm going to do. I'm going to first take cash flows to equity. So if you go to the previous page, 50 million, 60 million, 68, 76.2, and the collective cash flow, I discount them at the cost of equity, and I get a value of equity of 1.073 billion. This company is exactly priced right. Alternatively, I could take pre-debt cash flows, 90. So if you look at the previous page, the pre-debt cash flows of the firm, I discount them back at a cost of capital. The cost of capital is a weighted average of my cost of equity, 13.625%, and my after-tax cost of debt. You discount them back at 9.94%, the value that I get for the firm is 1.873 billion. I subtract out the debt. This is like magic. I get exactly the same value. I wish I could tell you that this will always happen in your company, but I've made some implicit assumptions in doing this that are hidden in those numbers. Remember, I told you that you're going to get a weekly challenge every week. This week, you're going to get your first weekly challenge. In your first weekly challenge, this is what I'm going to ask you to do. I'm going to ask you to value the equity in a company directly. It'll be a very simplistic example. You don't have to do any serious calculations. The numbers will be given. Then I'm going to ask you to value the firm and subtract out debt. And you're going to get two different numbers for the equity. Then I'm going to ask you why. What is it about the way you estimated these cash flows or estimated discount rates that's causing the two numbers to diverge? So that's my first principle of valuation, consistency. You tell me how you estimate your cash flows. I'll tell you what discount rate you should be using. So you come to me and say, what's my discount rate? I can't answer the question unless you tell me whether the cash flows are to equity or to the firm, the pre-debt or post-debt, whether they're in dollars or reals, whether they're nominal or real, because your discount rate has to be matched up to the cash flows. You saw what happened with the Kennecott valuation, right? A mismatching can create horrendous mistakes in valuation. So before you dive in and get into the details, make sure that your cash flows and discount rates are matched up. Any questions on just the generic sense? Because I'm going to first set up what a discounted cash flow model looks like in different forms. So you're going to see the big picture. And then we're going to start to delve into the inputs that go into the model. So let's start by, because if you mismatch, and you can see the consequences here I've taken, so take this page, put a big X on it, because in the quiz, you don't want to end up in this page doing all these things, because these are the things I don't want you to do, right? Yes? Yeah. Currency is a choice, right? So if you pick a country, so let's what for foreign China. So you have a Chinese company, so you're going to value it in US dollars, or you're going to value it in renminbi? Oh, you want? You don't have to think. You pick, right? Because there's no wrong choice in currency. If you decide to value it in dollars, you need a cost of capital for that company in dollars, right? Your cash flows have to be in dollars because it's a Chinese company now. What does that mean? You've got to project the cash flows in yuan/renminbi, and you got to convert them into dollars. And to do that, what do you need? Expected exchange rates. We'll talk about how to set those consistently. What will drive your value then will be you now have dollar cash flows, which you converted from yuan, and you discount back at a dollar cost of capital. You'll get exactly the same value for the company as if you did everything in the local currency. The key is once you open that door and say, I'm going to do everything in dollars, you got to convert everything into dollars. Right? So in terms of the kinds of screw ups you see, first is I can take cash flows to equity at discount at the cost of capital. That's what was Boston did. Remember, they took after debt cash flows. If you do that, you're going to overstate the value of equity, which is exactly what Foster, because you're using not even the low discount rate, you're using the wrong discount rate, cash flows to equity. I could take cash flows to firm and discount them at the cost of equity. I've seen people do this as well. If you do that, you're going to understate the value of the firm because you're applying a discount rate to the cash flows that reflects what equity investors want. Of course, when you subtract out the 800 million, you come up with the value of equity. I've actually also seen a third variant, which is people take cash flows to the firm, discount the cost of equity, forget that they're even valuing the firm. At this point, they're completely confused, right? One cash flows to the firm, one is the cost of equity. They don't even know what they've computed a present value of. They don't subtract out debt, and they conclude the company is hopelessly undervalued, right? So every one of these mistakes can happen. Just make sure as you're doing it, you pick the numbers, you choose. There's no requirement that you have to do cash flow to equity or cash flow to the firm. Since you've chosen, make sure your discount rates reflect it. So let's think about valuing a company. Hopefully by the end of this week, you'll have picked a company. And one of the things you'll be thinking about is, hey, how do I structure valuation? I'll give you the generic structure for every discounted cash flow model. If you look at the cash flows, those cash flows can either be pre-debt or post-debt cash flows. Pre-debt cash flows are to the firm, post-debt cash flows to equity. If you look at discount rates can either be cost of capital or cost of equity. And when you think about growth, you got to be consistent about what you're projecting. Let me explain. If you're forecasting cash flows to equity, what's your measure of income that you're going to use? What's the income to equity investors called on an income statement? It's net income, earnings per share. If you're forecasting at equity cash flows, your growth rate has to be growth rates in equity income. If you're forecasting cash flows to firm before debt payments, the number you're going to be forecasting is operating income, earnings before interest and taxes, because you want to look at pre-debt earnings. Do the two growth rates have to be the same? I mean, you look across an income statement, you got gross income, you got operating income, you got a net income. Do they all grow at the same rate? In general, as you go down the income statement, do you know what's going to happen to your growth rates? They will tend to increase. A 3% growth in revenues will translate into a 7% growth in operating income. A 7% growth in operating income will become a 10% growth in net income. And a 10% growth in net income will become a 12% growth in earnings per share. And here's why. Because you have fixed costs at every level, right? Your operating expense, to the extent they're fixed and variable, growth rates and revenues will be lower than growth in operating income. As you go from operating income to net income, you have interest expenses which are fixed. You get net income growth. And then when you go to earnings per share, when you have buybacks, the number of shares can actually change. The reason I bring this up is when you sit down to value a company and you look for growth rates online, which you will, don't tell me you're not, you're going to say, what are other people estimating? You will find growth rates for your company estimated by equity research analysts. Those growth rates almost always will be growth rates in earnings per share. And if you apply that growth rate to revenues, you're going to overvalue the company because you've used the wrong growth rate. So as you think through valuation on every single input, make sure that you're being consistent about what you're forecasting and what you predict. So we're going to look at, if you look at variants of discounted cash flow models, we're going to look at 3 variants of discounted cash flow models. The oldest version of the discounted cash flow model is a dividend discount model. Dividend discount models are equity valuation models. The cash flow you look at is the cash flow actually paid out to companies as a dividend. Your job is to forecast out the dividends for the next 5, the next 10 years, discount them back at the cost of equity, you're done. The nice thing about the dividend discount model is you don't estimate cash flows. You let the company tell you what they pay out. That's the good news. The bad news is you're letting the company tell you what they will pay out. Do companies pay out what they can afford to in dividends? How do you no, they don't. How can you prove that companies don't pay out what they can afford to in dividends? It's on every company's balance sheet. Yeah. Because they have a cash balance. Google has $100 billion cash balance. Apple has $150 billion cash balance. Cash balances accumulate because you've chosen not to pay out what you can afford to. So we know companies don't know. Can Google afford to pay a dividend? Absolutely. Do they pay a dividend? No. The problem with the dividend discount model is you're essentially taking what companies pay, acting as if that's what they could have paid. And you say that's what the value of equity is. So the second version of the model, rather than trusting companies to tell you what they can pay, you actually estimate what they can pay. How do you estimate what they can pay? What should dividend be if you're thinking about a business and a residual cash flow is what you pay out? It should be what's left over after you've met every conceivable need, right? CapEx, working capital, debt payments. Is there a way you can estimate that for a company, what's left over after everything? Every other need? Is there a financial statement that actually tells you that? Retained earnings is an earnings number. Unfortunately, it's not a cash flow. You're thinking in the right terms, but I want something that's actually cash in, cash out. Look at the statement of cash flows. What does the statement of cash flows give you? It gives you cash flows you get from operations. It tells you how much cash you reinvested back in CapEx and working capital. It tells you how much cash goes to debt payments. And if you give me the statement of cash flows for any company, including Google, I can tell you what they could have paid out. Last year, Google could have paid out about $30 billion in dividends. That's what's left over after every conceivable need. When I decide not to go with dividends, what I do is I take the 30 billion. It's called free cash flow equity, fancy word, but essentially think of it as potential dividend. I discount those potential dividends back at the cost of equity. It's still an equity cash flow. And what I get as a present value will be the value of equity in the company based on potential dividends. So the dividend discount model and the free cash flow equity model are both equity models, but one takes the actual dividend, one looks at potential dividend. They can give you very different answers for companies that pay out dividends that really don't reflect what they could pay out. Yep. You are, in fact, that's exactly what you're doing, right? So in fact, that's the weakness of the dividend. The strength of the dividend discount model, I'll tell you the logic that people use. They'll say, look, I'm an investor in a company. I have no control. The only thing I get in the mail is the dividend. You can tell me all the free cash flows to equity you want, but I can't lay claim on it. It's a very specific, risk-averse way of thinking about cash flows. I understand the mindset, but I can also predict what kinds of companies you're going to invest in. You're going to invest in a lot of Con Ed and utilities and banks. You're never going to find a tech company attractive on a dividend discount model, ever. Then dividends don't matter because you set your dividends yourself. So there you definitely should go to free cash flows. There's no debate. But as an investor in a company, I can see the argument for I'm going to stick with dividends. I'm a conservative investor. This is what they pay out. And this is what I'm going to focus on. Right? So you got dividends and free cash flow to equity, both equity valuation models. The third model is free cash flow to the firm. Rather than looking at cash flows to equity investors, you look at the cash flows for all claim holders. Yes. No, they're all DCF. So let's not treat so dividend discount model is a type of DCF. What's the other type of DCF you think about? Free cash flow to equity. Don't ever say finish the word with free cash flow. It's got to be free cash flow to equity, right? Dividend models and free cash flow to the firm models can't be compared, but free cash flow to equity can. One is dividends, one is potential dividends, right? And to the extent, so if you take a company that pays out roughly its dividends, free cash flow to equity, Con Ed, for instance, regulated utility pays out about 98% of its free cash flow to equity as dividends. That's its history. The two models will give you roughly the same answer. The more the two diverge, the more the answers are going to be different. You are implicitly doing that. And that's why dividend discount model people stay with dividends. They say, how can I assume that I can't force it? And no, I understand it, but it also comes with consequences. Be ready to accept the fact that fewer and fewer companies are returning their cash in dividends. But remember, when you buy shares in Apple, do you own a piece of the cash balance? Don't do anything stupid like writing checks against it or something. That's not going to work. But technically, you are part owner of that cash balance. You have some of your money in T-bills through Apple. So technically, as a shareholder, that gets built into the price. So your argument is even if they don't pay it out, I benefit from a larger cash balance, and I'm going to count it as my money. Okay. So dividends, free cash flow to equity, free cash flow to the firm. It's easy in discounted cash flow models to do these dances. I have 16 different discounted cash flow models. Here's the way I think about discounted cash flow models. Every one of them has the same ingredients. You got cash flows, you got a discount rate, and you got closure in the form of a terminal value. We'll come back and talk about it. In the dividend discount model, it takes the form of expected dividends. So you're projecting out dividends. What does that require? It requires that you project out payout ratios. What percentage of income gets paid out? You project the dividends out in the future. You discount back at the cost of equity. And now let's talk about what this closure is. When you want to value a bond, what do? You take the life of the bond, you project out the cash flows over that life, you discount the cash flows back, and you got the value of the bond, right? The life is given. It's the maturity of the bond. It's a 10-year bond. There are 10 years of cash flows. When you buy shares in a company, let's say it's Kraft Heinz. Say you project out dividends next year, then 2 years from now, then 3 years from now, and 4 years from now. And then I ask you, what is the life of Kraft Heinz as a publicly traded company, equity in a publicly traded company? What is the life of a publicly traded company? When you look at the corporate chart, it tells you when the company is founded, right? With the case of Kraft Heinz, it might be 1912. When does it tell you the company is going to be wound up? It doesn't. It can go on and on and on forever, at least in theory. We know most companies fail at some point, but it can go on for a long time. This is a math problem from hell for us. And here's why. What do we say the value of an asset is? The present value, the expected cash flows in the asset over its life. And I just told you, Kraft Heinz could go, it's like an Excel spreadsheet that never ends, right? Can you imagine saying, I'm going to project cash flows every year, year 5, year 10, year 15,555, and you're still working on the Excel spreadsheet. Can't do that, right? So in valuation, you get to a point and you say, you know what, I'm exhausted. I'm not projecting cash flows anymore. You can't ignore what happens after that point in time. You try to estimate what the value of your business will be at that point in time. This terrifies people, but I'm going to give you a way of thinking through this. If you're willing to tell me when your company will become a mature company, you're saying, what the heck is a mature company? A mature company is one that grows at a rate less than or equal to the growth rate of the economy. I can give you a little trick you can use to estimate what the value of your company is at that point in time. Have you ever seen the equation for a growing perpetuity? When I tell you there's a cash flow growing at 3% a year forever, it's a very simple present value equation. You take the expected cash flow and you divide by R minus G. It's not magic. Mathematicians discovered this equation 200 years ago. It's an infinite series in math. What we do in discounted cash flow valuation for closures, we project our dividends for the next 5, the next 10 years. In the end of the 10th year, we say, you know what? This company is a mature company. Its dividends will continue to grow at 2% a year forever. Now you see why it's got to be mature, because you can't have a company growing at a rate faster than the economy forever. And you put the closure by estimating what that terminal value, present value of cash flows beyond year 10 will be. That's what a terminal value is. It allows you to bring closure into a discounted cash flow valuation without having to do a year 11, year 12, year 13. So in a dividend discount model, you're going to get dividends. You're going to get a growth rate in dividends, right? Because you got to project net income and payout ratios. You're going to discount them back at the cost of equity. And eventually, at some point in time, you assume the stable growth to get a terminal value. That's a dividend discount model. If I showed you a free cash flow equity model, here's what you're going to see. It's going to look exactly like the dividend discount model, but instead of looking at dividends, I look at potential dividends. A lot more work, right? Because now I have to compute what that is. Don't worry about the actual equation. We'll spend time on how we compute the free cash flow equity. Remember what I'm trying to estimate. Cash flows left over after every conceivable need has been met. And as in the dividend discount model, there's a point in time in the future where I say, you know what, this company is a mature company. I'm going to compute a terminal value. Set the two equations, set the two models next to each other. They look exactly alike. The difference is, instead of dividends, I'm looking at potential dividends. And if I do a free cash flow to the firm model, again, you have the same process. You estimate cash flows, but now the cash flows are pre-debt cash flows. Cash flow to the firm. I discount them back at the cost of capital. Why? Because they're to the firm. And here again, year 5, year 10, I said, this company is a mature company. I'm going to put closure. I'm going to get the terminal value. Every discounted cash flow model has this structure. The only difference is, how do you get the cash flows? How do you get the discount rate? How do you put closure? So keep that in mind, because otherwise you can say, well, 6 different models. How do I memorize all of them? It's one model with 6 variants, depending upon how you decide to approach your discounted cash flow valuation. So now let's spend some time on talking about the process of doing discounted cash flow valuation. I picked my company to value, and I'm going to pick another company next week, but I hope you pick a company soon. And you get ready to value the company. What's the first thing you're going to have to do? Collect the financials of the company, right? You're getting ready. This is the pre-work. It's far easier now than 20 or 30 years ago. You can go download the Tesla gives you every 10K and 10Q they filed. Don't get carried on and do every 10K of your Kraft Heinz. That might be 50 years, but you start to look at the history of the company. You're looking at past financials. What are you looking for in those past financials? When you look at the past financials of a company, what is it that you're looking to get clues on? What are the questions you're trying to answer? Yeah. One is what are the main business segments, but ultimately you care about what cash flows and risk. So what are you looking at? Okay, but in the same sense, you know, to project future growth, you might want to look at past growth, right? If I look at Kraft Heinz, you know what the growth rate has been for the last decade? Like 2%, 1%. Why? Because people don't really want cheese that stays liquid for the rest of eternity. Maybe people over the age of 65 might, but you're saying that's disgusting, right? Its core products are aging. Its market is aging. It is a slow growing business. So I'm looking to see how quickly this company is growing. Not necessarily because that'll be the same growth, but it's a starting point. Do I care about profitability? Yes, because growth alone doesn't deliver value. I look at the past to see, is this company a profitable company? Is it a non-profitable company? Kraft Heinz is a pretty profitable company. Again, doesn't tell you that the future will be profitable, but you're trying to get the foundations. And third, the case of Kraft Heinz, there's not much growth. But if you take Tesla, its revenues have gone up tenfold in the last 5 years. That's good, right? But you also want to ask a question about growth that I hope gets programmed into you. Whenever you see a company growing, the question you always need to follow up with is, how much did the company have to invest to get this growth? What does that mean? It built factories, it did acquisitions. I want to see how much is being spent to generate that growth. So the questions I'm trying to answer by looking at the past are basically questions that will launch me off into the future. What does growth look like? How much profits are there? How much did this company reinvest to generate growth? We'll look at the specifics of doing that, but that's why we look at the past. So we're not making assumptions that the past is a precursor for the future, but we're trying to get clues about the company by looking at its history. Now, I'll show you one of the graphs I churn out with almost every company to try to get that. I take the past 15 years, I look at growth, and I break it down into 5-year periods. Why? Because I also want to get a trend of, are you going from, you take Alibaba, take the last 15 years, you have incredible growth first 5 years, amazing growth for the next 5 years. And if you look at the last 5 years, you get this leveling off. Why? Because multiple reasons. The government has turned against you. The market is kind of leveled off. You're a big company. Those are all things you're going to use as the basis for telling your story about Alibaba and making your projections for the future. So don't get obsessed about the past. You think, what if I have a company? Any of you planning to do young companies? You take a company, some of you might, right? You think, what if I have no history? Fine. So does everybody else looking at this company. There's not much you're going to learn by looking at the past then. You'll be on more dangerous ground going forward. Doesn't make it impossible to value. It does mean that you have to make more judgments. So we look at the past to get clues for the future. You look at revenues, you look at margins, you look at reinvestment being whatever the company has to invest in to get the growth. And then comes the tricky part of valuation, which is you have to forecast the future. I'm going to give you two pathways. One is if you have a company which has stable margins, right? Its margins around 15% every year. Your life actually got a little easier because you now can just forecast out operating income because your revenues and your operating income are going to grow at the same rate. In fact, I'm going to take you through this process. The growth rate for a company with stable margins is a function of two inputs. How much you reinvest, reinvestment rate, what percentage of your income do you put back in the business, and how well you reinvest. Captured with the return on equity, return on capital, something to capture. So if you're a company that's reinvesting 50% of your income every year and earning a 20% return on capital, algebraically, your growth in operating income is going to be 10%. So that's a very specific case. Stable margins. For most of you, that's not going to work. Your margins are going up, the margins are going down. Kraft Heinz, I think the margins are shrinking over time. You can't assume margins will stay stable. So there's a second path, and this is my more generic path. This is the spreadsheet I'm going to give you that allows you to kind of mechanize what your forecasts are. It's built around three inputs. First, I'm going to ask you, what will revenue growth be in the future? You say, I don't know. This is your job in valuation, is to make your best judgment. You could base it on the past. You could base it on what you see changing in the company. But revenue growth gives me the growth part of your story. And we'll talk about all the inputs that go into whether you set a high number or low number. Second, I'm going to ask you about your margins and your profitability. And here again, I'm going to give you a choice. Right now, you might have low margins, but you might think, hey, economies of scale are kicking in, margins will improve. It's your company. I'm going to go along with your story about profitability. And third, I'm going to ask you, you've given me this great growth path. How much will you need to reinvest to get that growth? Every discounted cash flow valuation, those are the three drivers of what I end up as cash flows. You can end up with 100 inputs, but those are the three key numbers. And I do this to project out my cash flows. And it can be cash flows of firm, cash flows to equity, whatever you want to do. And again, I can't keep doing this forever. At some point in time in the future, I assume your company is a mature company. We'll talk about when that might be for your company. And we put closure in the sense beyond that point, my cash flows will grow at 2% a year forever, 3% a year forever, 4% a year forever. And to discount all of these cash flows, what do I need? I need a cost of equity or a cost of capital, right? Cost of equity, cost of capital, by taking finance have become equations and models. I want to give you the intuition behind what drives the cost of debt and what drives the cost of equity. The cost of debt for a firm is the rate at which you will lend money to the firm today, long term. We'll come back and talk about why today and long term are significant. So what's going to determine, you're a banker and I'm a company, it's come to borrow from you. What are some of the things you're going to look at before you decide what interest rate to charge me? Ultimately, you want to get paid, right? You want to make interest payments. So you're going to look at my financials to see, am I making a lot of money? You're also going to see how much have I borrowed because you want to see whether there's a risk that I might not pay. You might look at my credit history. If I've defaulted in the past, you're probably going to be a little more reluctant to lend me money. And after doing all of this assessment, you're going to come up with a default spread. The default spread would you charge over and above the risk-free rate, and that's my cost of debt. So that reflects what I can borrow money at. Think about the cost of equity. This is going to get messy. Remember, you were equity investors in my company. You bought my shares. The cost of equity is the number you had in your head as your required return when you bought my shares. Now, do you see why cost of equity is going to be a nightmare to estimate? I've got to be a mind reader. We'll talk about what we do in finance to get us around the problem, because if you have a publicly traded company with thousands of shareholders, saying, how the heck am I going to read all their minds? And here's the second problem. After you've read all their minds, their cost of equities can all be different. You're allowed to use only one. For 70 years in finance, we've wrestled with this question. How do you come up with one cost of equity for a publicly traded firm? But you need those numbers to get this process going. I know for the moment, it looks like there's lots of stuff to come, but we're going to take it a piece at a time to keep it manageable. That's why today I'm going to start with the discount rate. In particular, talk a little bit about the risk-free rate. So here's the sequence that I adopt when I have to value a company. First, I'm going to look at the past. I mean, it's good to start with the past, get a handle on what the past tells me about the company, and accept the fact that for some companies, you're going to have a long history. And for some companies, not that much. Right? Second, I'm going to try to assess the risk in that company and bring it into a discount rate. That's going to be the discussion for the next probably 2 or 3 sessions. We're going to talk about assessing risk, bringing discount rates. Third, I'm going to try to estimate growth in the future. Try, because nobody knows what the growth is. I'm going to try my best. So growth and margins and future cash flows. Fourth, I'm going to apply closure and saying in year 5, year 10, and it's going to be different for different companies so that I can do the terminal value. And finally, after I'm done with all of this stuff, I'm going to tie up loose ends. Say, is there something I've missed? So I'm going to check to see, is there anything else I've missed? And we'll talk about what those loose ends might be. That's the sequence. And to get the sequence started, I want to talk about, at least start the process of talking about discount rates. This is the D in the DCF. So let's get this number nailed down before we go to the CF part of the DCF. So let me restate that consistency question. If you ask me, what is the discount rate I should apply? I'm going to go back and say, be consistent. What does that mean? If your cash flows are to equity, your discount rate has to be cost of equity, cash flows of firm, cost of capital. If your cash flows are in dollars, your discount rate has to be in dollars. If your cash flows are real, your discount rate has to be real. Kind of remind yourself of that mantra, because that's so critical, is to get the process rolling. You got to make a choice. And once you make the choice in your cash flows, your discount rate will be predetermined for you based on that choice. So I want to talk a little bit about about where in a discounted cash flow valuation we bring risk in, and more generically about where does risk come from? Sounds like a stupid question. No, we talk about risk all the time in finance, but where does it come from, right? Now, in a discounted cash flow valuation, the only place risk shows up, and let me repeat that again, is in your discount rate. Your cash flows are expected cash flows. The discount rate becomes the receptacle for risk. The reason I bring this up is I often see analysts double counting. This is a risky company. I'm going to haircut the cash flows. You know what that means? They take their expected cash flows and knock off 10, 15, 20% to be conservative. You've screwed up your discounted cash flow valuation when you do that because you end up double counting risk. So in a discounted cash flow valuation, it's the discount rate that carries the burden of carrying risk. And if you look at what goes into a discount rate, it starts with the risk-free rate. Or put differently, if you don't know what the risk-free rate is in a currency, you can't do any discount rates. You've lost that mooring. So let's spend some time talking about where risk comes from. Now, when I sit down to value a company, and I would suggest this exercise for you, it's cathartic. Make a list of every single thing you're uncertain about. You know how long that list is going to be? You're going to find that everything in the valuation is uncertain. Even the risk-free rate, you might not find to be certain in some currencies. Make a list. It's going to run 2-3 pages long, 50 items. And it's going to be overwhelming. So what the heck am I going to do? 50 types of risk to worry about. Here's what I want you to start to do. I want you to take those risks and put them into buckets. Here's the first set of buckets. Is the risk estimation risk or economic risk? You're saying, what's the difference? Economic risk comes from things you don't control. Inflation, interest rates, crises, political risk playing out. Estimation risk comes from going out and collecting more data. So here's how. So if your risk estimation risk, doing more work will make it decrease. Collecting more data will make it decrease. Economic risk, you can't do anything about. And I have some bad news for you. In most valuations, almost all of the risk is economic risk. The reason I say that is often, especially if you're caught up in your type A personality, you want to get every I dotted, every T crossed. You say, let me just go collect more data. Let me do more research. And I'm suggesting there's a stopping point at which you'd say, look, I've done the best I can with estimation risk. The rest of the risk, I call this the karmic point in risk. We say, the rest of the risk is out of my control. I'm essentially going to walk away from the estimation versus economic risk. The second classification of risk is into micro risk and macro risk. Take Tesla. What are the macro risks in Tesla? The interest rates could go up or down. The economy could strengthen. I would even include things like what percentage of people are going to end up with electric cars. There's political, legal, tax issues playing out there. That's macro risk. You know what micro risk is? Risk specific to the company. What will Elon Musk do this afternoon, tomorrow, 2 days from now? This is a company with a lot of micro risks. The reason it makes sense to separate the two is macro risks play out in your discount rate, and only macro risks. Micro risks get averaged out in a portfolio. In other words, if I have 30 companies like Tesla, thank God I don't, but if I do, you're hoping that the Elon Musk-like character in each company is doing something that offsets the other. It's a law of large numbers. So micro risks get passed through, macro risks show up in your discount rate. And the third grouping of risk is into discrete risk and continuous risk. Suppose you're a US company with European operations. Every moment of every day, your value is changing every time the exchange rate changes, right? It's not a bad thing or a good thing. It is reality. That's continuous risk. In contrast, let's say a US company with revenues and earnings from a country with fixed exchange rates. So there's no risk, there's no risk, there's no risk until one day you wake up and what happens? There's a 70% devaluation. There's a lot of risk. That's called discrete risk. Let me ask you a question generically. As a company, as an investor, which of these two risks would you rather face? Continuous risk or discrete risk? Which do you think is easier to manage, easier to hedge? You want to try? Continuous risk every single day, right? There are products you can get to manage continuous risk. You can live with it. And I have some bad news. In finance, all our tools are designed for continuous risk. Discount rates are just for continuous risk. So one of the things we're going to talk about is how do you value companies that face discrete risk? Like what? A company that faces nationalization risk. That's a discrete risk, right? Your company's worth a lot unless it gets nationalized. A company that's distressed. What's a discrete risk you're facing there? It might not make it. Discrete risk. A company that's exposed to terrorism risk. Discrete risk. We'll talk about the tools you need, but the tools are not finance tools. They're decision trees, scenario analysis, probabilistic tools. It's healthy to break risk down because you deal with the risk very differently. So now I'm going to set the table for how we think about risk and finance without bringing in the explicit agenda of risk and return models. When you think about risk in investing, the first thing you have to remember is not all risk matters. Some risk will show up in your discount rate, some will get passed through. You can't treat all risk as equivalent. Second, when you think about how risky is a company, I want you to take yourself out of the equation. You're saying, but it's my money. It doesn't matter. Because from a risk perspective, you have to think about risk through the eyes of the marginal investors in your company. You think, who are the marginal investors? They're investors who can actually affect prices. Let me ask you a question. Do you think you can affect the price of Apple? And neither can I. Why? This is a $2.5 trillion company. To move its price, you need hundreds of millions, perhaps billions of dollars in investments. So who do you think the marginal investors in Apple are going to be? Right? In fact, hedge funds probably don't have the money either. It's going to be Carl Icahn tried to move the price of Apple and he gave up because he was able to accumulate only like 500 million worth of position in a $2.5 trillion company. People said, we don't care. The marginal investors in companies will tend to be institutional investors. You're saying, so what? You have to look at risk through their eyes. Why is it going to be different? Because when an investor who's diversified looks at a company, the risk that that investor sees is the risk you cannot diversify away. You don't need elaborate mathematics to see it. Basically, if investors who are diversified look at companies, the risk they measure will be the risk they cannot diversify away. That is the Markowitz revolution. That's where finance was born. The new perspective on risk. It's not the total risk in a company, it's a risk you cannot diversify away. That diversification effect is going to significantly change how we think about and measure risk in a company. Many of you in your foundations class probably derive betas. Every time you use a beta, what you're implicitly assuming? The marginal investor in your company is diversified because betas measure only the risk you cannot diversify away. It's built on this building block. So, you look at every risk and return model. It starts in 1964 with the CAPM, the arbitrage pricing model, the multi-factor model. We can list out but the bottom line is all of these models, no matter how complex you make them, are built on the presumption that the people pricing your stock are diversified investors. Could that get you into trouble sometimes? Are there companies out there where the marginal investor is not diversified? We're going to talk about valuing private businesses. Private businesses are held by a single owner. That single owner is almost never diversified. Why? How can they afford to be diversified? You're a doctor, you own your practice, your entire wealth is tied up in the practice. In many private businesses, the marginal investor is not diversified. None of these models work directly. We have to adapt them. This diversified investor argument is central to how we think about risk and finance. And I want you to get comfortable with it. You might disagree with it, but at least be aware of the fact that that is the assumption driving how we think about risk. So let's go back to the oldest risk and return model in finance. The capital asset pricing model. 1964, Bill Sharpe and John Lindner, who derived the model, won Nobel Prizes for it. It's changed the way we think about risk. It comes with a whole lot of baggage. But in spite of all of the criticism thrown at this model, it still is. You go to Bloomberg, this is how they give you the inputs to get a cost of equity. You go to companies, you go to consulting firms, people still use it. And in the capital asset pricing model, if you look at what gives you an expected return, you start with the risk-free rate. And that's what we're going to wrestle with the rest of the day. You have a beta, which assumes that the rest of the risk gets diversified away. And you multiply the beta by what's called an equity risk premium. I know this, people think of this as some kind of abstraction. The equity risk premium is the price of risk in the equity market. It's what investors are demanding for investing in equities as a class. Risk-free rate, beta, equity risk premium. You see, what if I don't like the CAPM and I use a multi-factor model? You still have the risk-free rate, you still have the equity risk premium, but you now have 3 or 4 betas and 3 or 4, it's the same process. So I'm going to focus on the CAPM, not because I don't think you shouldn't use any of the model, but because whatever I say about the CAPM, you can generalize to any of the other models. And all of these models start with the risk-free rate. So that's where I'm going to start. I'm going to start with defining the risk-free rate and then talking a little bit about how do I get a risk-free rate in a currency. So I'll give you my starting definition for a risk-free rate. For something to be risk-free, you need to know exactly what you will make. Guarantee. Let me repeat that again. For something to be risk-free, you have to know exactly what you're going to make. Guaranteed. Let's take an example. You have a 1-year time horizon. You're going to see why your time horizon matters. And you buy a 1-year T-bill. If you go to the US Treasury auction, you can actually directly buy a T-bill. I think this morning the rate was 5.03%. So you take your money, you invest in a T-bill. And let's say you hold for a year. A year from now, if I come and knock on your door, what's the actual return you'd have made on the T-bill? 5.03%. Unless the US Treasury defaults, which is an implicit thing that we have to worry about here, you're going to make exactly what you thought you would. A 1-year T-bill is risk-free if you have a 1-year time horizon. Let's say you bought a 10-year T-bond instead. You hit the wrong button. You bought a 10-year T-bond. You still have a 1-year time horizon. Is a 10-year T-bond risk-free if you have a 1-year time horizon? Why not? So you get the coupon, that's guaranteed. But when you sell it, why might the price change? It's a treasury bond. There's no risk. So why would prices change? But there's a reason they change, right? Every time interest rates go up or down, prices change. You know what the price of a 10-year T-bond did in 2022? It was the worst year in bond market history. The 10-year T-bond, that supposedly riskless instrument, was down 20% during the course of the year. Why? Because T-bond rates went from 1.5 to 3.9%. Already you can see for something to be risk-free, and you want me to ask me what the risk-free rate is, you got to tell me what your time horizon is. If it's 1 year, I'm going to look up the 1-year T-bill rate. If it's 10 years, I might give you a 10-year T-bond rate. If it's 5 years, a 5-year treasury note rate. There's no such thing as one risk-free rate. It's a function of time interval. Second, you ask me what the risk-free rate is, and you don't tell me what currency, I'm kind of lost, right? Because a risk-free rate in euros is going to be very different from a risk-free rate in dollars. Currencies matter. And finally, when I was taught risk-free rates, eons ago, in an MBA program, you know how much time you spent on risk-free rates over the 2-year MBA program? 30 seconds. Here's what I was told about risk-free rates. Use the US Treasury rate. Let's move on. Shows you how dollar-centric the program is. This is 1979 through 81. And how there was the implicit faith that if you have a Treasury note, it must be risk-free. Why? Because the assumption was treasuries don't default. Have you been reading the news stories about what the ratings agencies are doing to the US sovereign rating? Moody, S&P lowered the US rating in 2012. Moody's is, I think, thinking about, they put it on a watch list. There's a very real possibility that the next time I teach this class, there might be default risk in the US Treasury. And we'll talk about what to do if that happens. But clearly, you're implicitly making an assumption about default risk when you use a government bond. With the US, I might do a song and a dance and say, oh, trust me, the Treasury. But if I have the Zambian Kwacha government bond rate, trust me, there is default risk in there. And we'll talk about why even in local currencies. So what I'd like to do to introduce risk-free rates is take you through a series of questions, and very simple questions. And each one, give me your instinctive answer, right? In valuation, you try to value a company by projecting cash flows for the next 10 years, and in a sense, forever. Your cash flows are long-term. Let's say I'm doing everything in US dollars. So I want a US risk-free rate today. And I'll give you some choices in the risk-free rate. You tell me which one you're going to latch on to as your risk-free rate. I could use a 3-month T-bill rate. What's wrong with that? Your cash flows are forever. It's a duration matching problem. A T-bill rate should never, ever, ever be used in a DCF valuation. About 1 in 5 DCF valuations I see use the T-bill rate as a starting point. Already, you're in the muck, right? You can't use a 3-month T-bill rate. A 10-year T-bond rate, 3.88%, we're getting a little closer, right? Longer term. But you could actually argue that cash flows continue beyond year 10 forever. There's an argument that you should be using a 30-year T-bond rate or longer if you can find it because your cash flows are really long-term. I'll make a confession. I use 10-year T-bond rates as my risk-free rate, even though there's an argument for the 30-year. And here's why. There are lots of other inputs I need, risk premiums, default spreads, and those are really difficult to compute if I use a 30-year rate as my base. So it's pure convenience. But if you made it just about the risk-free rate, I would pick the 30-year rate as my risk-free rate because my cash flows are long-term. Now, some of you might be familiar with what's called a TIPS rate. You know what a TIPS rate is? How does it work? Right now, in the start of 2024, it was 1.53%. So if you bought a TIPS bond, what are you going to make on that bond next year? You're going to make 1.53% as your starting bond. But you know what? TIPS bond is called an inflation-protected bond. So think about what inflation protection means. If next year the inflation rate is 5%, you'll make 1.53% plus 5%. Next year, the inflation rate is 2%, you'll get 1. So now do you see why you're inflation protected? I will pay you whatever the inflation rate is plus 1.53%. So what does that make the 1.53%? What kind of risk-free rate is that? That's a real risk-free rate. We talked about real cash. If you want to do everything without inflation in it, that will become your risk-free rate. Clearly, I'm not doing everything in real terms. It won't be a choice, but maybe if I'd done everything in real terms, that would be my risk-free rate. So in US dollars, I'd use the 10 or the 30. I prefer the 10 because it's more convenient, but a long-term US dollar rate. And then I'm going to get down on my knees and say, please, God, don't let the US Treasury default on me, because then my whole risk-free rate gets blown up. Okay? Let's take a second example. Let's suppose I asked you for how many of you are planning to do European companies, even if you haven't picked a company. Okay, what country? Switzerland. Okay, that Switzerland is a little murky because it's not the euro. So anybody planning to do a UK, I'm sorry, not even a UK company, a French company, a German company, a Dutch company? No? Anybody want to do a Dutch company? No? Okay. Let's suppose you decide to do a Spanish company. Spanish companies are going to report all their financials in euros, and it's convenient to do the valuation of the same currency. You want a risk-free rate in euros. How did I get the risk-free rate in US dollars? I found a 10-year government bond rate, the T-bond, and I use the rate, right? So this should be easy. I should be able to go find a 10-year government bond rate in euros and use that rate. The only problem is at the, and this was at the start of 2024, this is what the rates look like. These are all governments that issue 10-year bonds in euros. They're not different currencies, but the rates are all different. So here's my question. If I'm looking at a Spanish company, which of these rates would I use as my risk-free rate in euros? Should I use Spain has its own rate, 3.05%. Can I use that as my risk-free rate? Why are rates different? I mean, they're all 10-year bonds. They're all in euros. What's causing the rates in Greece to be higher than the rates in Spain, to be higher than the rates in Italy, to be higher than the rates in Germany? People worry about default risk. Are you worried about default risk with Greece? You'd be crazy not to, right? You think of how close they got. And already you can see the answer. The rates vary because there's default risk in some of these rates. And what do we say about something risk-free? There can be no default risk. So let me ask you the question again. You're doing a Spanish company in euros. Which of these rates will you use as your risk-free rate? The German rate, but be very specific why. It's not because it's German, but because it's the lowest. So 5 years from now, the Portuguese 10-year rate is the lowest. Miracles can happen. I'd be using the Portuguese rate. It's the lowest rate because I want to get as close as I can. It doesn't matter whether it's an Italian, a German, or a Greek company. If you're doing it in euros, your risk-free rate will be the German euro bond rate. Now let's make things messier. We're going to be valuing some Indian companies, and I want to value them in Indian rupees. I want a risk-free rate in Indian rupees. It's going to get tricky. I go find an Indian government bond, 10-year bond denominated in rupees. The rate at the start of 2024 on that bond was 7.18%. I'm home free, right? But what's the one stop I have to make before I use the 7.18% as my risk-free rate? I have to stop and ask, is there default risk in the Indian government? This is going to be, who am I going to go ask this question? Some people are going to get insulted even if I ask this question. I don't want to deal with that. So here's what I did. I went to the Moody's website. And if you go to the Moody's website, you got to register. It's free. Go ahead and register. And you click on this group called Sovereign Ratings. What Moody's gives you is 2 ratings for every country. They rate 150 countries. They give a foreign currency rating and a local currency rating. Anybody want to explain to me what the 2 rating, why there are 2 ratings and what they're measuring? What does a foreign currency rating measure? It measures the risk that Moody's sees in India when it issues bonds in dollars or yen or euros, a foreign currency. What does the local currency rating tell me? What Moody's sees as default risk when they issue bonds in rupees. I was hoping, I was praying that I'd see AAA under the local currency rating. Because then I'd have used the 7.18% as my risk-free rate and blame Moody's if something went wrong. Said, look, I trusted them. But I didn't have that out. In fact, they gave me a Baa3 rating. Not a horrifically bad rating, but it's not AAA. So what's Moody's saying? There is default risk in the Indian rupee bond, which also means the 7.18% is not going to be a risk-free rate, right? Because embedded in it is it's going to be. So it's an algebra problem. 7.18% the government bond rate. Some of it is for default risk. If I can figure out how much, I should be able to clean up for it. Next class, we'll do this in more detail. But I have a lookup table. If you tell me the rating for your country, I'll tell you what the default spread is for your country. With a Baa3 rating, the default spread was 2.39%. So 7.18% of the government bond. If you trust my default spread, 2.39% of that is for default risk. Do you see where I'm going to go to get a risk-free rate? I start with the 7.18. Am I going to add or subtract out the 2.39? Subtract out, because I want to take out default risk. My risk-free rate in Indian rupees is going to be 4.78%. Now, I did this, I've been doing this for a while, and every country where I do this, I get pushback from the audience. And here's what the pushback is. They said, countries should not default on local currency bonds. There's actually a rationale for it. Why should countries never default on local currency bonds? What should they be able to do? Print the money and pay it off, right? And that's technically true, but here's my pushback. Half of all sovereign defaults in the last 50 years have been local currency defaults. You think, why would they not print the money? If you print the money and pay off the debt, you've avoided default risk. But in the process, what have you created? Inflation, you've debased your currency. And given a choice between debasing your currency and defaulting, countries have discovered that it's easier to come back from default than it is from debasement. I'll leave you today with a story from Latin America. Okay. I went to Brazil every year between 1997 and 2018. The first time I went to Brazil in 1997, it was 5 years after hyperinflation in Brazil, 5,500%. Nobody in Brazil could issue long-term bonds in reais because nobody trusts them. It took the Brazilian government until 2006 before they could issue long-term bonds in reais, 15 years. That's the price of debasement. In contrast, in any just world, should anybody lend to Argentina ever again? I mean, this is a country that managed to default every 4 years this century, and they keep coming back. Remember that. Countries can choose to default, and if they choose to default, the government bond rate has to be cleaned up. And that's basically what I'm doing. So next class when we start, you're saying, where did that 2.39% come from? I'm going to take you through the process of estimating default spreads so that you can do your own cleaning up.
Oh, ended up working, Professor?
I'm sorry?
Remote ended up working?
Yeah, thank you so much. I appreciate it. He's an outside speaker, I think, yeah. Sorry about that, and
Different risk-free rating, it's real for like the projection period in terminal.
you could, but you want to go down that path, I'm gonna argue this, if you do it right, it doesn't make much of a difference to your value. In fact, the low T-bond rate days, I would let people get a second shot when they got to terminal value, 10 years out, saying you could use a forward rate in the market, see maybe it's going to be 2.5 or 3%. The effective value is surprisingly small. So if you want to do it, it's open, but the effective that have in value is going to be muted because of something else that happens to go to the cost.
Okay, and then for the default spread, do we still subtract from the US currency or no, because the US doesn't really have.
And AAA has zero default. So you're still subtracting our defaults, it just happens to be zero. That's why I said if a year from now, the US loses its AAA rating from Moody's, this is the last rating agency that treats it as AAA. I'd be doing for the US what I did in India. I do that for the UK right now. UK 10 years ago had a AAA rating. I used to use the gilt rate as my British pound risk-free rate. Today I have to subtract out a spread because the UK is now AA. So and France is the same thing. If they had their own currency, anytime a country falls away from the AAA, it doesn't mean you can't estimate a risk-free rate, but you got this added step.
Okay, and then where does, I remember seeing on your website, one of your videos, like the specific industry, like there's like a specific industry adjusted data, like what we're gonna talk
We'll
about.
talk about that. All right, we're going to start with the risk-free rate, then we'll move to equity risk-free, with close with both.
Okay, great, thank you.
Hello, Professor.
Hey.
So you mentioned at the beginning of class that we calculate the